Right. Good evening, everybody. I believe that we are standing in between this session and the most important session of today, which is the lucky draw, right? So we hope to make this session insightful and concise with great takeaways from our panelists. So to kickstart, I have a question to all the panelists over here. It's that 2024 has been actually a very good year in all the markets. And based on this, managing your portfolios, what will be your biggest lessons and takeaways, the good ones, the bad ones, and how will this frame your investment strategy moving forward in 2025? So yeah, Mr. Gan Leong, can, I'll open this question to all the panelists. So we have,
Yeah, hello. Yes. So, what did I learn from 2024? So, basically, I think every year, if I think because I just did the presentation, right? So every year there's always that one or two champions, especially in the Malaysian market, that one or two large caps that do extremely well, and usually unlikely they can replicate that performance. So for us, is we have to constantly be looking what companies can do well, and essentially for us is our investment methods have been quite simple throughout the years. Always do not get too hyped up about things, because when people get too excited about things, multiples get too high. When multiples are very high, it means expectations are very high, and when expectations are very high, just very little things can cause massive sell down. So I think we have to consider that sometimes when we invest in any companies or any stocks, right, whether it's an overcrowded trade, whether it's too crowded right now. So how do you determine that? Usually multiples, P multiples, price to book multiples, these are the things we look at. And then we look at what kind of earnings prospects. Are people too optimistic? Is your consensus of market too optimistic? So we have to balance these things out and not get, time and time again, people get too excited, I know, Bitcoin keeps going up, right? And, people keep telling me, there's no tangible value, but it keeps going up because the momentum is there, right? But I mean, for us, when we invest in equities, we're investing in companies. And when you're investing in companies, these things matter.
I guess for me, if I refer back to the markets I was talking about earlier, which is China, I think time in the market is important, because I think China last year came out to give us pretty decent return, roughly about 15%. However, the returns came within a very short period of time. They have two big outperformance periods throughout the whole year. So going back to the saying, it's time in the market rather than market timing, right? I think market timing, easier said than done. Even the professionals, will find it very, very difficult. And I guess a lot of us here do have our day jobs, and it's tough to really time the market. And therefore, I think time in the market is probably one of the key lessons to be had in 2024. Yeah, thanks.
thank you, Slow.
For me, the lesson to take away from 2024 is we have to see market expectation can be way off from the actual outcome. So let's say just look at the US interest rate scene. Back in early 2024, market was expecting as much as a 6 rate cut for the year, and that translates to about 150 basis point of a rate cut. So as it turned out, inflation was stickier than expected, and the US economy was quite resilient. So what actually happened is rate cut didn't happen until the third quarter of the year. And then again, for the whole year, the rate cut was only 100 basis point. So what I want to say here is that investors, whether it's fund managers or individual investors, we need to factor in new developments in the market and see how that affect our investment thesis, our views on the market, which is like what my fellow peer mentioned. It is really taxing. We have to be on our toes, especially coming into 2025, where most of the whole market expect it to be more volatile compared to last year. So that's where the role of active fund managers come in here to evaluate all these changes in the market and reposition, review our investment calls.
Thank you, Mr. Low. Mr. Christopher?
So I have the benefit of going last. I can hear everything. I kind of want to echo all of that, right? So I would say don't go where the consensus is, because we entered 2024. If we jog our memories back, right, recession was a buzzword, inflation was a buzzword, China slowdown, etc., right? Stay defensive, stay out of the market. End up market say 20+%, right? Global equity. So I think time in the market is important. But what's also equally important is to pick where expectations are not extremely elevated. So keep a mind on valuations. Keep a mind on where earnings growth could be. And in our minds, where valuations are a lot less demanding, it's outside the very crowded area. Certain parts of the US, mega caps, I think that's where valuation risk reward isn't fantastic. Earnings, we are likely, like I said in my session, right, earnings growth will likely be a bit more carried by areas outside of the mega caps. So maybe that's where your risk reward is pretty good, right? Valuations not overly demanding, earnings starting to accelerate versus mega caps slowing down. So maybe you think of all of that when formulating your investment plans as well.
Right, thank you, Mr. Christopher. So if I can summarize this, right, as a key takeaways, you can write this as your note, right? From Mr. Ganyong, Mr. Chito, Mr. Lua, and Mr. Christopher will be valuations, looking at that, time in the market, looking at the trends, and also active management. So that actually gives me confidence actually to keep my EPF investments, especially from the Malaysian funds, still intact. And to the audience here, right, we do have on the FSM platform where you can actually use the EPF Invest platform to actually invest in EPF approved funds, where most of the funds are actually Malaysia funds that have Malaysian equities. Do check that out, and it's 0%. No time limit in the promotion. Okay, and then just to add on this, right, we see that despite the headwinds, recent headwinds like higher for longer interest, from your perspective, we have heard a lot of speakers today. What will be the in one or two words, key catalysts or drivers that needs to happen in the market that you look forward in 2025? So all the panelists are welcome to take this question. Oh, yeah, let's do a random, like Mr. Lu.
Okay, for this year, I think the key thing is on the interest rate. I think expectation is kind of muddied because we are expecting interest rate to ease from this level, but recently because of the US elections, that expectation kind of moderated and still affecting certain markets like REITs to be specific. So for this year, we do maintain our view that the financial conditions will continue to ease. So that helps, especially the REITs asset class, in terms of lower interest costs and also better access to capital. And that allows REITs to capitalize on increased transaction in the market, look at rebalancing the portfolio, how they can recycle those that have matured and make more accretive acquisitions. So those are the things that we're looking out for among the REIT managers that are able to execute this better than the others.
Thank you, Mr. Lu. So for REITs, we'll be looking at interest rates. And Mr. Ganyo?
So basically for us on the interest rate expectations, right, I think right now if you look at the policies that Trump proposed that he will implement when he comes into office, it's very scary for inflation. But nevertheless, like I say, I still believe that he's pro-business and pro-markets. And in that case, that's why I do not believe that he's going to implement this all at one go, even if he wants to do it. But I think it's more of using it as a bargaining chip. But then if you look at what's going on in the bond markets today, I think people are pricing in very strong inflation numbers coming in after implementation of Trump's policy, which I think that there is potential for bond markets to actually reverse from where it was right now, because I think that right now people are just being over-worried.
Right. Thank you, Mr. Ganyo. Mr. Jitun?
For China, I think they are in a more enviable position. I think destiny is in their own hands, in the sense that There's lots of policies that they can enact. They can cut RRR, they can cut interest rates, they can expand their fiscal deficit, they can expand monetary policies, they can support the market, establish stabilization funds and all that. So, and a lot of the, like what you mentioned earlier, the drivers are actually in their own hands. So it's a matter of when they want to activate those drivers and how hard that they want to pull those drivers. So I do think that I would look towards more insular factors for China, despite the fact that I think on the backdrop of Trump tariffs and all that will continue to rear its ugly head throughout the year. Yeah.
Right. Thank you for the insights, and Mr. Christopher.
Yeah, I'll make two broad message on two levels. So one, on a very general equity level, it has to be earnings. Valuations have done all the hard work in the last 2 years plus. Earnings must kick in from 2025 onwards to drive markets higher. And in our minds, global equity should roughly grow about 10% this year. Tech, faster, 20%. So to us, that's where the faster growth is. Now my level two is beneath the weeds, certain markets are pricey, right? Valuations rich, so valuation compression might offset some of this earnings growth. On the other hand, outside the crowded areas, there's some room actually for valuations to expand, given how discounted they are to the crowded areas and earnings growth. So really focus earnings growth and valuations. Make sure you're not overpaying for valuations. That's how we're looking at it this year.
Thank you. So what I can summarize here is that for the past 2 years in 2023, 2024 has been a good year. But this year, there are pockets of opportunities, but we just need to be a little bit cautious in how we position the portfolio. And moving on is that, Mr. Jutun, this question for you. A lot of our investors who have been following us over the years have been invested in China, especially those who came in 2022. They are seeing their portfolios in the rate up to -40, even 50%.
Sure.
And what will be your advice or insights to
Okay.
them?
Okay. So I guess if you look at China, like I mentioned earlier, last year was a pretty decent year, about 15% up on the year-to-date basis. I guess prior 3 years they were down, and I think like what I mentioned earlier during my presentation, a lot of it was self-inflicted from the perspective that I think Xi Jinping was implementing his common prosperity policies. He was trying to control the internet sector, the property sector. So a lot of it were I would say, of their own doing, right? So I think that has passed. For clients who may, or even clients who are sitting on 40% losses, I think a lot of them may have come in right at the peak, right? Because peak to trough now is roughly about 40%. So I guess for clients who have gotten in at the peak, I think like what I mentioned in my slides previously, I think this is a great time for them to average down. I think throughout the entire sessions we have talked about average dollar cost averaging. I think these are all very sensible strategies that retail investors can adopt, because all of us have their own day jobs, and you can utilize obviously FSM channels to help them with their investment processes. So once again, I guess the short answer is I think it's a great time for them to dip their toes back into the stock market, because policies have changed, valuations is cheap, like a lot of panelists here have mentioned earlier in terms of valuations. So I think these are the two big reasons for me to advocate a position in China at this juncture.
Thank you for the answer. And for all those investors, you can also reach out to us if you have further queries on this, and also the panelists themselves later on at the back. And to add on that, it's right. We have seen your convictions, your plan for 2025. But besides that, are there any contrarian view that you actually hold in your respective markets? Mr. Kanyang, give it a go.
So basically, I think we hold one of the most contrarian position with our investment, our positioning in oil and gas sector. I think you look across most funds in Malaysia, domestic funds, I think most funds have less than even 5% exposure to oil and gas. Whereas for us, I think we have about 15 to 25% across various funds exposure to the energy sector. And I think I've mentioned it earlier last year, why I like them, and I still like them because I think earnings have delivered last year, and I think earnings will continue to deliver this year. If anything, I think it will surprise on the higher side, where it should beat most consensus of market expectations. Valuations is cheap, as one of the lowest levels that we have seen. I mean, back then, before 2014, oil and gas companies trade at 20 over times PE. Then, of course, it derated. There's reasoning behind the derating, but then it derated to your low teens. And today we are looking at high single digit. I just don't see them trading at low single digit. So I think earnings will grow if the valuations stay at its current levels. We are looking at still double digit returns. Total return, because a lot of these oil and gas companies has cleaned up their balance sheet. Unlike last time, people are worried that oil and gas companies' balance sheet is very stretched. They're highly indebted. They can't afford to pay dividends. Today, quite a fair bit of those companies that we invested in are paying decent dividends. 3% comparable to what you get in money markets or fixed deposit. So it gives us it covers our opportunity cost if we were to hold cash. Then on top of that, if its earnings were to grow 20-30%, that's potential multiples to rate back to your 7-8 times, assuming that it doesn't go back 10 times. So I think from that standpoint, the upside there is quite attractive for us. But nevertheless, it's one of the worst performing sectors last year. It could very well be one of the worst performing sectors this year, but we still like it, and it's a contrarian pick for us.
I believe that your answer gives that it's good to be contrarian, but as long as the view holds and it shows in the performance of that. And Mr. Christopher, also the similar question, in contrarian view, besides the tech that you mentioned earlier.
So I represent tech today, right? So for us, one of the more contrarian views, in fact two, would be to be underweight the Mag 7 in our tech strategy, right? To have no holdings is NVIDIA. To be underweight the US, because essentially those were the leaders over the last 2+ years, right? For tech especially, and then global equities. So we find that risk reward in some of these names are rich. Based on what we're hearing on the ground, actual demand for AI is actually not as explosive as what these prices are suggesting. Don't get me wrong, we like the trend, we find it's positive for the long term, but in the very short term, markets are baking in a lot of expectations, especially in some of the mega cap names. So to us, risk reward not great, we're underweight, have no weights in some of these names. Yeah, so that's really our bigger contrarian positions for now.
Yes. In my case, I would say within the REITs market, we are bullish on the Australian market, even though if you can recall from my presentation earlier, the dividend yield for the market is actually not high, about 3.2% for next year. But why we still like it? Because we expect certain REITs in Australia, they're able to still deliver besides dividend yield, but also relatively healthy profits driven by their developments, especially so within the data center space. Also, Australia's side, we are expecting, because of the inflation pressure there is a fair bit as well. So they do have a room to implement a further interest rate cut. So that's one of the market that we're bullish on. Despite, if you see, let's say Japan has about 5% yield, Singapore 6%, Hong Kong 8%, but we're still generally positive on some of the Australian names.
Right, thank you, and Mr. Jitun.
For me, I think my contrarian bet would be the big China internet giants. I think they have derated quite a fair bit. A lot of it is, like I mentioned earlier, in terms of flows flowing out of all these names. A lot of foreign investors used to love them to death. And now I think it's also causing them to go into this deadly spiral right now as they trim their holdings over the course of the last few years. So my view is that I think a lot of investors are mistakenly underestimating the value of these companies. Earnings are probably suboptimal right now. Reason is because I think it's not right, inverted commas, for them to make too much money at this juncture, especially when the whole country is undergoing this common prosperity drive. So once permission has been given for them to start earning money, then things might change quite dramatically. So I do think that I feel that you need to smell that something has changed in the air at this juncture. So I do think that I think my contrarian bet would be the Chinese internet giants.
Thank you. And the reason for asking this question is that this is the advantages and the value that the active managers actually bring in to all the investors through the active management way of investing. It's by having a contrarian view that's different from the market, and this is where they actually generate alpha. And now you actually hear it from the managers itself, how they actually view it, and how actually they manage it to actually give the performance that's superior. So just also related to that, the next question will be, currently, in this juncture, investment sentiments and behavior actually have shifted significantly in the recent years, especially with the advancement of ETFs. We have seen massive inflow of ETFs in the US markets this year. So how do you see these changes affecting your investment strategy, and how could active managers actually manage this?
Hello? Yeah, so basically, I think Warren Buffett have constantly preaching on, people should just buy ETFs, right? Because ETFs outperform most of the mutual funds in America, right? But I think in Malaysia's case, at least for us, number one, if you look at the CI index, other than last year, for most years, right, KLCI actually struggled to deliver positive returns. Maybe slight positive returns from a total return standpoint. So buying a KLCI ETF, you might as well just keep your money in EPF, right? Because you get a 5-6% return. So a KLCI ETF will likely underperform your ETF, and maybe could possibly underperform, your fixed deposit. Also depends on what rates you get. So for us, I think in Malaysia, active fund managers still bring value. I think actually in emerging markets especially, in America, it's a more developed market, so it's a bit different. So I don't think you can compare like for like. Like for instance, if you want exposure in small caps in Malaysia, what ETF can you buy? There's no small caps ETF. You only can buy a small cap fund in Malaysia. And also, that's where we think as fund managers, we bring value. So I think for investors, right, when you evaluate, yes, ETFs do charge you a lot lower fees. But whatever returns you see when you invest in our mutual funds is net of fees. So whatever returns we generate net of fees, if it's more superior than the ETFs, then it makes sense for you to invest, regardless whether it's 1.5%, 1.8%. Yeah, ETF could charge you 0.2, but it doesn't matter because net of fees, which is generating better returns for you. And so far, I think for us, most of our domestic funds or equity funds have been outperforming the CI index by quite a significant margin. So I think for us, please continue investing in our funds.
Okay, thank you, Mr. Gan Leong. And Mr. Christopher, this is to you. It's that Mr. Gan Leong mentioned that for emerging markets, but not so in the US markets. And how so in the tech space then?
Yeah, so I think we can all appreciate why flows have gone to ETFs in tech in the US, right? Markets have been so concentrated. A couple of stocks drove the whole market, what for by an active fund, right? But that also in some way is the flaw of passive ETFs, because they have to buy what is the heaviest weight in the market the most in the ETF, regardless of valuations. So if our view, and I think panelists broadly share the same, the market should broaden, right? The cheaper part of the markets could catch up. Your ETFs would then be light in those positions, whereas on the active front, we can overweight what we think makes the most sense, valuation, earnings coming back. So that's where we really start adding value. When the markets become a bit more rational, when breadth becomes wider, there's a lot more room for stock picking in our minds. 2025 onwards, the next few years, the likelihood of that happening is increasingly higher.
Mr. Lu, for in the REITs?
Okay. Actually, for me, even though REITs are passive investments, actually we do think it has helped fund managers in terms of active management. And internally at M Funds, we do use some ETFs in our fund strategy to complement our investment strategy. Granted that the offerings here in the domestic market, there's not that many ETF, but in the regional space, there is a diverse offering of ETFs out there. So sometimes we fund manager use ETFs to get efficient and a quick exposure to certain market, let's say the restricted ones like India or Taiwan, or to certain sectors or thematics that are in play. So I guess it does help active management in a way to complement our investment strategy.
Thank you, Mr. Lu. And Mr. Jitun, why funds and not ETFs?
I guess I will agree with all the panelists here. I think especially in emerging markets, I think there's a lot of scope for us as fund managers to go in and try to buy the best stock. I do think that unlike maybe large caps, US equities, large cap Euro equities, even European, even Australian equities, I think using ETF to get exposure to those makes a lot of sense, because I think information, it's very widely available. There's not much scope for people to to run around. But for emerging markets, I think Malaysia, China, Asia in general, I think there's a lot of scope for us to derive stock selection. So for our funds, RHB Cap China Fund, I think we have been consistently outperforming the benchmark. So I do think that there is a lot of scope for us to beat the ETF from that perspective.
Thank you, gentlemen. So the key takeaway that I can get from here is that the question is not why ETF or funds, it's why not ETF and funds. So you could consider both, and also you can do this together on the FS1 platform. And to wrap up today's sessions, right? Today's session's title is How Not to Lose in 2025. And as the great legendary investor Warren Buffett said, that the rule number 1 of investing is not to lose money. And rule number 2, it's do not forget rule number 1. So what will be your key takeaway to our investors? One piece of advice that would help them to navigate 2025?
I think it's basically what I've mentioned earlier. Be mindful of the valuation that you're paying for the companies that you're investing in. Don't just chase whatever is the hottest stock. It's very common, people get carried away, stocks doing well, you're like valuation 20 times, 30 times, 40 times, it's okay, it's fine, it's a good company, right? But then when the stocks were to come down 20%, then you're like, 40 times now, 32 times. Well, 32 times is still quite expensive, right? So then you're like, maybe come down another 10%. Well, actually 28 times not very cheap. So you see, that's the thing. People tend to get caught up with the hype. They buy the hottest stocks in town, and then obviously when things are doing well, no one question it, everyone's happy. It's always when things turn bad, and that's when you regret your decision. That's why, when we speak to a lot of people say, hey, I buy this stock, I make how much money? They say, hey, but that time you say you buy this stock, right? Now it's not doing so well, what happened? Oh, that one I just keep a long-term investment, long-term investment. I don't, that one, I think 5 years, 10 years down the road, I keep for my children. So you see, you have to look at it from a total portfolio perspective, A lot of times, people don't look at that. They will look at like winners, I buy this stock, I make 40%. Wow, your funds only make 15%, not so good. Make 20%, not good enough. I make 30%, I buy this one stock, But then, you have to weigh with the stocks that you bought that lost 30% also, right? So I think we have to look at it from a holistic standpoint, not just, just looking at just your winner, but you have to, I think for most people who invest, that's why I always look at it from a whole portfolio standpoint, and not just stocks, not just equities, but you take account of your fixed income allocation, your money market allocation, whether it meets your daily demands or your. So I think do not go overly aggressive and just put all your money in equities. Just have a balanced portfolio. That's what I would recommend people.
Great insights. Thank you, Mr. Ganyong, Mr. Jitun.
I guess not all of us can be Warren Buffett. So the only way not to lose money is maybe just put in fixed D, but that's not obviously a choice available for all of us if we want to retire comfortably. So I think the smarter way probably is to take risks intelligently. I would echo what our panelists have mentioned earlier. If you buy stocks that has gone up a lot, valuation is expensive, then chance of you exposing yourself to large losses is obviously there. So I think having a portfolio approach obviously makes sense. You have a bit of bond, a bit of sector segments that looks very, very cheap or are trading on cheap historical valuations like Malaysia, Asia, China. I think all falls into that basket. But if you want a bit of excitement in tech, I think that's fine as well. But it's all about having a sensible portfolio approach to investing in 2025.
Right. Thank you, Mr. Jitun.
For me, the advice would be for individual investor is to stay invested in 2025. A lot of our panelists have spoke about more volatility, but studies have shown that staying out of market because of volatility means investors may lose out on the best trading days that follows after that. So that means actually investors lose out from the significant earnings opportunity in a recovery period. So also to recap what the others have mentioned about, especially so those sectors that have derated recently and reaching an inflection point, be it China or even REITs. So I think it is more, the more reason for us to stay investors and look for opportunities amid all these volatilities.
Thank you, Mr. Lu. And
I actually was planning to say all that they said, but I don't want to repeat. So I would say, in Chinese, there's a word called 危机, right? 有危就有机. So stay invested. Do not be frightened by volatility. It will happen. When it comes, think of how to reorganize portfolios, pick up quality companies and areas you've been looking at. So that is my summary, I guess, to add on to what they said.
thank you, gentlemen. So to all the investors, right, to wrap up today's session is that you have sit the whole day. You have seen all the different presentations. I'll say that I was actually also together with you at the back looking at the presentations. Key takeaways here, volatility is here. Do we be afraid of it? Or do we still keep invested in the market? And at the same time, make use of the features like the regular savings plans that we have on the platform, and find good quality companies with good funds through our recommended funds, and wish you that a good and prosperous year ahead in 2025. And with that, thank you, everyone. Let's take a picture.